One of the biggest and most common mistakes that investors make is suffering from a home bias. What this means is investing all of your assets in the country that you reside in. This will put your portfolio in a weakened state, it'll increase your risk, and it'll definitely reduce your returns. Let's take a closer look. I'm Anna Hilberry. Please like and subscribe to my YouTube channel. Sometimes when we have a new client relationship, that client will express concern about investing outside of Canada. They feel like they're being risk averse and more conservative by investing in something they know and understand, which is Canada, when in fact the opposite is true. I'm going to go through an actual example for you of how the home bias can negatively impact your investment returns. I had a new female client, and when we initially set up her account, she declined to invest outside of Canada. She felt concerned over currency risk and uncomfortable with investing in the United States. At the time, the Loonie was trading around 91 cents US. I explained that by diversifying her assets outside of Canada, she would actually be reducing her risk and, in my experience, would improve her return. It was January 2014. By October 2015, we'd had several account reviews, and I pointed out to my client that the US stock market, the S&P 500, had produced 10 times the return of the Canadian stock market, or the TSX. To my client's credit, she understood the value of diversification and she agreed to invest internationally. You may ask yourself, how is it that the Canadian and US stock markets can vary so widely? And the answer is because our economies are different. Let's go through a simple example. I'm going to use the TSX, S&P TSX, as a proxy for the Canadian economy and the S&P 500 as a proxy for the US economy. I'm going to look at the top two constituents of each of those stock markets. And by constituents, I mean the top two industries that make up the stock market. So in Canada, it's financials and energy, and they make up 48% of the Toronto Stock Exchange. In the US, it would be information technology and healthcare, and those make up 38% of the S&P 500. Let's look one step deeper. Jonathan DeRoche, president of National Bank Investments, recently put out a commentary comparing Apple to the Toronto Stock Exchange. In his commentary, he noted that the market capitalization, or the entire market value of Apple as a company, was soon to dwarf the Toronto Stock Exchange. My point is, there are companies like Apple that trade in the US, and we don't have anything like that in Canada. So it's really important to diversify your portfolio and to diversify outside of Canada. I'm Anna Hilberry. I hope this has been helpful for you. Thank you for listening.